Today I want to have a look at Target Corporation, ticker TGT, and today the company saw a large decrease in their stock price by about 8% or $12.5. And the reason for that is that they released their quarter 2 earnings. So let's have a look at them right now. The earnings weren't positive at all. They reported a 1% decline in earnings to 2.03 per share, while revenue slid by 3.1% to 24.53 billion. Furthermore, the adjusted earnings sat at $1.80 per share versus the Wall Street predicted target earnings of $2.20 per share. Now, to figure out whether it is a good idea to buy Target at its current trading price, we'll jump over to my stock valuation spreadsheets. Now, the first thing we can see is that the current dividend yield of Target is sitting at 3.07% with a dividend payout ratio of $4.40. That gives us a trailing free cash flow payout ratio of just above 40%. Now, I really do like this trailing free cash flow payout ratio, but I will show you why I might be slightly concerned further in the video. Now, the current trading price of Target is sitting at $143.27, with analysts predicting a price of $181.50 by the end of the year. The institutional ownership is sitting at 81%, which is rather high, and the beta of the company is sitting at 1.17. Now, moving to the 9-pillar analysis, we can see that all the pillars are sitting in the green except the increasing free cash flow. But except for that, we can see that the revenue and the net income of the company have both been increasing, and that the company has been buying back shares at a rate of about 2.5% per year. Now, when a company buys back shares, it is a great thing, as it essentially means that you own a larger percentage of that company over the years it buys back shares. Now we can also see that the 5-year profit margin is currently sitting at about 28.12%, and that the long-term liabilities over the 5-year free cash flow negative dividends is sitting just below 2, which essentially means that the company can pay off all their long-term liabilities in about 10 years. Now, scrolling down to the financials, we can see that the PE ratio has been decreasing slightly over the past 5 years, which means that you will be paying a more fair value compared to the company's earnings. Now, I want to point out the issue I have with Target's dividends. If we have a look, the free cash flow of the company has been decreasing slightly over the past 5 years, with the quarterly dividend growing, and by quite a lot, from $0.66 in 2019 to $1.10 in 2023. Now, all dividends are paid from the free cash flow, and therefore when the free cash flow of a company is decreasing and their dividends are growing, it means that in the future their free cash flow payout ratio will increase, and when the free cash flow payout ratio increases, it means that the company won't have enough money to buy back shares and to overall expand. And we can see this even better from the graph on screen. We can see that the free cash flow hasn't increased by almost anything since 2011, but the dividend payout has increased by a lot, by many 100%. And even though the company is currently decreasing their shares outstanding and therefore they will be paying less in dividends, it still isn't enough to stop the payout ratio from rising. Now, if you find these spreadsheets helpful and think that they would help you in evaluating companies that you want to add to your personal portfolio, you can access them at my Patreon, which I pinned in the link in the description. Now, scrolling all the way down, we can see that other than that, the earnings per share of the company have been increasing slightly, and that the free cash flow per share has been decreasing, which only shows that even though that the shares outstanding are decreasing, it doesn't balance out the free cash flow decreasing. Now we can move to our first valuation model, which is the Grams formula revised. And here, as always, we take the trailing earnings per share, the base PE, 5-year growth estimate, growth rate multiplier, average yield on AA corporation bonds, and the short-term average yield on AA corporation bonds over the past 5 years to properly challenge our trailing earnings per share. Now, using this formula above the Grams formula, we get an intrinsic value of $218.94, which is 35% higher than the current trading price of the company, showing that based on the company's earnings, it should be valued at a higher price. Now, moving to our discounted cash flow model, we take the free cash flow over the past 5 years and calculate the average growth rate to be sitting at negative 107%. Now we have to take into account the analyst growth rate projections over the next 5 years and take into account the research we did in the backend and the 9-pillar analysis to calculate the growth rate over the next 10 years. Now based on all of this, I calculate a growth rate of about 2% per year and calculate the future free cash flow including the terminal value. After that, using the discount rate which I plugged in at 7%, I will calculate the present value of all of that future free cash flow, and summing that up, adding cash and cash equivalents, subtracting total debt, I will get an equity value. And then when I divide that by the shares outstanding, I get an intrinsic value which is sitting at $156.25, only slightly above the current trading price. Now we can move to our third valuation model, which is the multiples valuation. And here we will compare Target to companies which operate in the same sector, such as Walmart, Dollar General, and Kruger. Now the point of this valuation is to compare Target's current earnings per share to companies which operate in the same sector current earnings per share. So we will take the stock price of these three companies and divide by their earnings per share to get their PE ratios. We then average out these PE ratios and multiply by the current earnings per share of Target to get an intrinsic value of $211.96. And this shows us that Target is undervalued compared to companies which operate in the same sector, specifically to their current earnings per share. Now we can move to our final valuation model, which is the dividend discount model. And here we will take the dividend payout over the past 5 years and calculate the average growth rate to be sitting at 14.31%. Now Target's 2021 and 2022 increases were very out of hand, and compared to the increases they have done in the prior years and compared to our free cash flow payout ratio analysis I did, I will project a growth rate of about 2.5% over the next years. Now using that, I will calculate the next year's dividend, and then using the WACC of the company, we will arrive to our intrinsic value, standing at $95.33, which is below the current trading price of the company. Now we can move to our ultimate valuation, where we will average out the 4 models we did prior and arrive to our intrinsic value, sitting at $170.62, which is 19% higher than the current trading price of the company. Now, if we plug in a margin of safety of say 20%, we would get an acceptable buy price at $136.49, only about $7 lower than the current trading price of the company. Now, I'm not here to show you if you should or should not buy a company. I rather want to teach you a process of how to value a company properly. And that's also one of the reasons why I created these valuation spreadsheets, to teach you how to value a company properly. Now, to be fully transparent, I did buy Target at its lowest in 2023. So if we plug in 360 days over the past year, we can see that on the graph I bought Target at somewhere around here, and I saw a return of more than 30%. Currently, though, I'm not buying more shares of Target. I'm rather investing my money into other companies such as PayPal, to which I did a video a day ago, so if you want to, you can go check that out right now. And with that, if you enjoyed the video, make sure to let me know down in the comments which company you'd like me to evaluate next, and make sure to leave a like and subscribe, as it really helps me out.